Hello class, my name is Jared Mosoti from the School of Business and Economics, Department of Accounting and Finance, Mount Kenya University. I'll be taking you Financial Management 2. In our lesson today, we'll be focusing on agents theory. So our topic of discussion is agency theory. That is our topic. Now we go straight to the introduction. What is the meaning of agency theory? Agency theory refers to a relationship. When we are talking about agency alone before the theory, it refers to a relationship that subsists or exists between two parties when one party, known as the principal, engages another party, referred to as an agent, to act on his or her behalf. The principal will give the agent authority and a mandate to act on his behalf for the benefit of the principal. Now this means all the actions of an agent are aimed at benefiting the principal. The actions of an agent, therefore, bind the principal because of this kind of relationship. In finance, we have a divorce between ownership and management. The stockholders, who are mainly the shareholders, are the owners of the firm, while the managers are the agents. Therefore, in this case, we can see a relationship between the agent, who is the manager, and a principal, who is the owner. Now, why in the modern day businesses are the owners not involved in the day-to-day running of their businesses? There are quite a number of reasons why the stockholders cannot directly manage their own business. One of the reasons is they may not have the necessary skills and expertise to run or manage the firm. This therefore means they must get someone who has the required skills and expertise to run the business on their behalf. Another reason is they may not have sufficient time to run the firm. Ordinarily, these are people who are busy elsewhere, and they may not have sufficient time to attend to the busy issues of a business. Therefore, they must act through an agent. Another reason is geographical dispersions. The owners may be geographically dispersed in a way that it will not be possible for them to meet or converge in one place to run the affairs of the business. Then, it may also not be very easy for many owners to run a single firm. The ideal firm in the modern day world is a company that has a number of owners, and these people may not necessarily agree on various decisions. Therefore, to consolidate decision making, it becomes more viable to hire a few individuals who can run the business on their behalf. These and many other reasons make the firms in the modern day world to engage the services of the manager. Therefore, our firms are ideally entrusted on professionals who manage the affairs of the business. Now, we go to our problem now. That is what is bringing about this agency issue. We have the agency problem. Where does this problem come from? Ideally, from our introduction, the owners give capital, they contribute capital, and they entrust these resources to a person or persons referred to as managers. These people are supposed to make use of these resources to generate returns which are for the benefit of the principal, who are the stakeholders. Therefore, the managers are entrusted with these resources, and they are expected to take good care of the resources and account to the owners, who are the shareholders, at the end of the financial period. This process, or the concept of entrusting resources to an individual or groups of individuals, and then requiring them to report back to you at the end of a given period, is commonly referred to as stewardship. So in essence, the agent's problem revolves around stewardship. Since the directors are required to report back to the owners on how they have used or utilized the resources entrusted on them, there arises a situation where the managers may have not acted in the best interest of the owners. In this case, you find a conflict arising between the agents and the principals. This arises where the agent pursues his or her own goals at the detriment of the interests or goals of the shareholders. Now, that is where our agent's problem revolves around. Now, that is not the only problem that we may have between the owners and the managers. We have many other stakeholders in the modern day business that will bring about other related problems that we can refer to as agency relationships. Some of the relationships we are going to focus on are the shareholders versus management. We'll also focus on the shareholders versus the long-term creditors, the shareholders versus the auditors, the shareholders versus the government, and we have the shareholders versus the branches. We go straight to the first relationship, that is the shareholders versus the management. As we have indicated earlier, the agent's problem revolves around the managers pursuing their own goals at the expense of the goals of the owners. So in this relationship, the managers always take actions that are not inconsistent with the shareholders' wealth maximization objective. Now, what are the causes of conflict between these two groups of people? That is the owners and the management. The first cause is the incentive problem. The managers have a fixed income. Their salary is fixed and is not pegged on their performance in many cases. Now, this means that the managers who are going to work so hard to earn the required returns for the owners are not having the necessary incentive or motivation to work extra harder. And this means that the motivation to go an extra mile on the part of the managers is missing, because they will be paid the fixed amount of money irrespective of how they performed in most cases. Therefore, this brings a problem or a conflict between the managers and the owners, because the managers will act in a way that will not optimize the gains of the shareholders. The other cause of the the problem is the consumption of PECs, or what we call the perquisites. This occurs where the managers will award themselves huge salaries and various fringe benefits that are likely to reduce the earnings of the firm. Whenever the directors and the managers increase their remunerations, it reduces the amount of earnings due to the shareholders. This, therefore, will reduce the shareholders' wealth through increased expenses. Then we have the differences in risk profile. Now, the managers will invest ideally in low-risk projects because they know they have a job to protect. The owners, on the other hand, prefer high-risk projects that will bring higher returns. Now, the managers are not going to act in the best interest of the owners when they take low-risk projects that will have low returns. Therefore, that will also bring a conflict between the two parties since there is a conflict in their risk profiles. Then we have the differences in investments and evaluation horizons. By nature, managers focus on the short term, while the owners focus on the long term. Why do managers focus on the short term? Because they are not likely to be in the organization for a very long period of time. They would like to invest in projects that will yield returns in the short run and take the credit. On the other hand, the owners, the shareholders, prefer long-term investments which are basically consistent with the going concern concept. So we can see there again, a conflict is going to arise when managers take a short-term project that is likely to reduce the firm's earnings in the long run. Then we look at the management buyouts. This takes place where the managers will prefer to buy shares or acquire shares of the company, and in the long run, they become the owners of the business. Basically, that means they are staging a coup inside the business through the involvement in the buying of the shares of this company. Now, how do we solve these problems? The first suggested solution to the problem is the compensation plans. The shareholders should compensate the managers well or adequately to give them the required incentive and motivation to act in their own best interest. Then we have board of directors. We can have some of the owners participating in the day-to-day running of the businesses. Then we can have takeovers. These are used mainly to punish managers who have not acted in the best interest of the company. When the company has not performed well, the takeovers can be used to punish them. Then we can also have specialists monitoring the activities of the managers. Lastly, we have auditors who are engaged by the owners of the firm to run the business on their, to audit the activities of the management. Our next relationship is the shareholders versus the long-term creditors. The shareholders are the owners. The shareholders are the owners, and they have the responsibility of raising capital to finance the various projects. In Financial Management 1, we had seen that there are two main sources of finance. We have debt finance and we have equity finance. Where the owners are not able to raise capital through the internal means, they resort to getting or raising the funds from outside sources. And one of the most common is the long-term creditors. So the long-term creditors will extend loans to the firm with the hope that the firms will invest this money wisely and generate returns to the owners and be able to give sufficient returns to the lenders that comes in form of interests. So their hope is to get the interest plus the principal amount back after a specified period. So in this type of relationship, the shareholders become the agent and the long-term creditors are the principals. So we expect the shareholders to act in the best interest of the lenders, that is, to invest the money wisely and generate returns and be able to return the money they have lent and give sufficient returns as per the requirements of the lenders. So then, what are some of the causes of conflict between these two parties? One of the causes of conflict is the disposal of assets used as collateral for the debt. In some cases, the shareholders may decide to dispose the assets that they have used as security to secure the loans. This will be a source of conflict. Then we have assets stroke investment situations. This is where the shareholders and the lenders, that is the bondholders, agree on a specific low risk project. But ideally, the shareholders decide or substitute that project with a high risk project, and therefore putting at risk the amount of money lent by the lenders. This means that the bondholders are now going to be exposed to higher risks than what they had agreed. Then we can also look at another source is the payment of high dividends. The expectations of the lenders is that the value of the firm should remain the same over the agreed period, and it should not at any one time reduce the market value of the shares and the market value of the bonds. If the shareholders decide at some point to pay higher dividends, that ends up reducing the value of the firm, this will be contravening the agreement with the lenders. The other source of conflict is borrowing more debt capital. Ideally, once the shareholders have used one asset as collateral, the expectation is the same asset should not be used again. But in some cases, some shareholders or some firms may decide to use the same asset again to secure another loan. Now, in the event the firm is collapsing, the lenders may end up losing if they are not given priority when liquidating the firm. Then we also have another source of conflict that is under investments. This is where the firm fails to undertake a particular project or fails to invest the capital they have borrowed from the lender in the projects they had proposed. In some cases, they may underinvest. They invest a small amount of what they have borrowed, and they end up diverting the other amount to other projects that may not give the same return as the one expected by the bondholders. Therefore, this ends up giving the shareholders an upper hand when it comes to compensating the lenders. Now, what are some of the suggested solutions to this problem? One is to improve restrictive debt grants. Now, this means you incorporate strict terms and conditions in the loan agreement or in the bond covenants. For example, no disposal of assets without the permission of the lenders, no payment of dividends from retained earnings, no borrowing of additional debts until the current debt capital is repaid or fully serviced. Then the bondholders may recommend the type of project to be undertaken in relation to the risk level of the project. Another one could be maintenance of given liquidity levels by the borrower as indicated by the current ratios. Then another solution is provision of a sinking fund. This is where the firm is providing a specific amount of money every year towards the repayment of that loan. That means at no time will the firm have no money required to service the loans. Then we have callability provisions. This is where the bondholders or the lenders may decide to require the borrower to pay the debt before the agreed time. This takes place in a situation where the borrower has defaulted or has failed to pay the interest as agreed. Then we have convertibility. This is a situation where the bonds can be converted into ordinary shares. That means now the lender becomes the owner of the firm. This can take place especially if a firm is having liquidity problems and is facing challenges of liquidation. Then we have some cases you can refuse to lend, where the company has a history of failing to pay. The lender can refuse or can turn down a request made by this borrower to get another loan. Then another solution can be representation. The bondholder may demand to have a representative in the board of directors of the borrowing company to oversee proper utilization of the borrowed capital. Then we can also have transfer of assets as a solution. Now, this is where legal ownership is transferred from the borrower to the lender. This basically takes place in a situation where the borrower is unable to pay and there is no other way. The asset has to be transferred to the lender. The other relationship we are going to focus on is the shareholders versus the auditors. Auditors are professionals who are appointed by the shareholders to certify the financial statements of the books of account prepared by the managers. Now, their major aim is to check whether the reports represent a true and fair view of what took place during a given financial period. The auditors are therefore expected to monitor the performance of the management on behalf of the shareholders. In this relationship, the auditors are acting on behalf of the shareholders. Therefore, the auditors become the agents, the shareholders become the principal. Now, what is the problem between the auditors and the shareholders that is going to bring our agency problem? The first cause of conflict is a situation where they collude with the management in the performance of their duties. That means auditors who are expected to be independent will have their independence compromised. Then another source of conflict is where they demand high audit fees for insignificant audit work done by the auditors. Then another source of conflict is where they issue unqualified report that ends up misleading the shareholders and the general public. Then another source of conflict will be a situation where they fail to apply professional care and due diligence in the performance of their audit work. Now, how do we solve this problem? The auditors can be fired, they can be removed from office, especially at the AGM. Legal actions can be taken against them, and we can also have them being disciplined by their professional bodies. Like in our Kenyan situation, we have the ISPAC. It can come in to either suspend, withdraw their practicing certificates, fine them, or have them having to pay a penalty for their misdeeds. Then we have the shareholders versus the government. Now, this is a unique relationship between a company that is private and a government. The shareholders of a company are expected to operate within a given environment, that is within a legal jurisdiction. Now, they are given the license to operate by the government, and they are expected to operate under the set laws and the rules of the government in which they are operating. Now, this means that the expectation is on the owners of the company to act in a manner that is consistent with the required laws of that country where they are operating. The government, therefore, becomes the principal. The shareholders become the agents. The company must carry the business on behalf of the government, and at the end of a given financial period, they are expected to pay tax and any other payments that is due to the government. Now, what is the problem between the government and the companies? One is tax evasion. Now, this takes place when the management in collaboration with the shareholders, reduce or declare low earnings than they actually earned, so as to reduce the amount of tax payable to the government. The other source of conflict is where they involve themselves in illegal businesses or illegal activities, such as smuggling, drug trafficking, and others. Then the other source of conflict is lukewarm reception to social responsibilities and the calls by the government. The government expects companies to, from time to time, participate in social activities. When companies fail, it means there is a conflict between the government and the company. Then we have lack of adequate interest in the safety of employees and the products or services the companies are providing. Then another source of conflict is avoiding some areas which are encouraged by the government. Some areas where the companies are expected to venture in are ideally avoided by these companies for one reason or another. Therefore, that will bring a problem between the government and the shareholders. Now, what are solutions to these problems? One is to incur the monitoring costs. Now, monitoring costs will arise when the government incurs expenses when it is making efforts to reduce the agency problem between it and the companies. This will come in form of statutory audits and investigations of the activities of the company. Then, another solution is to open investment incentives. The government, to encourage companies to invest in certain areas, may decide to offer incentives to companies to entice them to invest in such areas. Then the other one is legislation that is coming up with laws which will govern how companies operate in a given country. The last relationship we are going to focus on is the head office versus the branches. Now, this is peculiar to the multinational companies that will find themselves operating in dispersed geographical locations. In this case, we will have one branch that is the head office and several other branches which are spread across the given area where the business is operating. In this case, therefore, the head office becomes the principal and the branches will become the agents. Ideally, the branches are expected to act in the best interest of the head office, where we have the main administration offices, but in some cases, a conflict will arise when they act in their own interest at the detriment of the interest of the head office. And therefore, to solve this problem, the head office can do a number of things. One of them is to frequently transfer the managers. The other one is to adopt a global strategic planning to ensure better communication of its vision to all the branches. Then the other one is to have a code of ethics that is governing how the managers operate in the various branches. Then the other option is to have an elaborate performance reporting between the various branches and the head office. Then another solution to this problem could be performance contracting of the managers and compensating them commensurate to how they have performed. Now, having looked at these relationships, we are going to have discussion questions for this lesson. One of the questions I would like you to focus on is, the first one is looking at whether the managers should be allowed to own sizable amount of stock in the company. If that is the case, what are the pros and the cons of such a move? Then the second discussion question is, during the last few decades, a number of environmental, hiring, and other regulatory charges have been imposed on businesses. In the view of these regulatory changes, is maximization of the shareholders' wealth any longer a realistic objective? Discuss. Those are the two questions we are going to focus on, and that marks the end of our lesson 1. Thank you for listening.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.